Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, I want you to imagine trying to run a multi-billion-dollar tech empire today.
Oh yeah, it's a logistical nightmare right now.
Right. Like you've just taken delivery of thousands of the most advanced, insanely expensive artificial intelligence chips on the planet.
It's just sitting there in boxes.
Exactly. They're sitting in boxes in a warehouse, and you literally cannot turn them on.
Which is crazy to think about, but yeah.
And it's because you literally do not have enough electricity on your local grid to power the wall outlet.
Right, the power grid it just isn't built for it.
And even if you did have the power, I mean, those chips run so incredibly hot, they would just melt their own plastic casings within minutes.
Oh yeah, they'd fry themselves.
So we need to unpack this because today we're looking at a company that is attempting to solve that exact existential bottleneck, Applied Digital.
Yeah, and what they are doing is, it's fascinating.
It really is. They are trying to execute what might be the absolute hardest maneuver in the business world.
Yeah.
Like a complete root-to-branch corporate metamorphosis.
Right. They're, actively pivoting away from their legacy operations, which was essentially Bitcoin mining.
Right. Crypto.
Exactly. And they're racing to become the premier physical backbone for high-performance computing, or HPC, hosting.
Which is a massive jump.
It's a fundamental shift in their corporate DNA. Moving away from a highly speculative, cyclical crypto model and transitioning into a company that builds critical physical infrastructure.
But the biggest technological shift of our generation, honestly.
Yeah. But the market is currently having a really tough time figuring out exactly how to value a company that is, quite literally rebuilding the airplane while it's in flight.
Right. And to see if this pivot is actually working, we have to pull apart their recent fiscal third quarter 2026 earnings report.
Which is a very messy report, to put it mildly.
Oh, absolutely. On the surface, the top-line growth is explosive. We were talking about $126.6 million in total revenue for the quarter.
Yeah, which is a massive 139% year-over-year increase.
That's huge. And the absolute star of the show was this new HPC hosting segment, which brought in $71 million all on its own.
Yeah, and that came specifically from firing up, or energizing, as they call it, the first 100-megawatt building at their Polaris Forge 1 campus.
Right, energizing it.
Exactly.
Yeah.
And generating $71 million from a single newly energized facility, well, it proves the demand is there.
For sure.
And more importantly, it proves they can actually execute on the physical delivery of that power. We're seeing them turn raw infrastructure into actual recognized revenue at a really rapid pace.
But the bottom line of this earnings report, this is where things get incredibly messy for anyone reading it.
Oh, yeah. The discrepancy is jarring.
Right, because you look at that 139% top-line growth, you get super excited, and then you scroll down and see a reported GAAP net loss of $100.9 million.
Yeah, a $100 million loss jumps right off the page.
But then, right next to it, management points to an adjusted net income of $33.2 million and an adjusted EBITDA of $44.1 million.
Which leaves investors scratching their heads like, which is it?
Exactly. For anyone looking at those numbers, are they making $33 million or are they losing $100 million? It's like, think of it like owning a functioning old-school textile mill, right?
Okay, yeah.
You realize the future is microchips, so you decide to tear down the mill from the inside out. You're ripping up floorboards, installing sterile clean rooms, buying billion-dollar manufacturing machines, all while still trying to run whatever's left of the old business just to pay the electric bill.
That transition period is going to look completely disastrous on paper.
Right. But is that what is actually happening here with this $100 million loss?
It is. If we look under the hood at the mechanics of accounting, we can see exactly why that discrepancy exists.
So it's an accounting quirk.
Well, yeah. GAAP, which stands for Generally Accepted Accounting Principles, it has very strict rules about how you report building massive infrastructure. Like when a company spends hundreds of millions of dollars laying miles of specialized fiber optics, pouring massive concrete foundations, and installing these heavy-duty liquid cooling systems, they don't just subtract that cash from their daily profits.
Right, because those are capital expenditures.
Exactly. GAAP forces you to capitalize those massive costs and then recognize them as depreciation over the life of the building.
Oh, I see.
So on paper, it looks like Applied Digital is just bleeding money every single month because of this massive depreciation drag.
So it's an accounting reality, but not necessarily a reflection of the actual day-to-day cash coming in the door.
Precisely. When you look at the adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization,
Yeah.
you are intentionally stripping out that non-cash depreciation.
You're removing the accounting drag.
Right. By removing the cost of the building, you get to see the actual cash engine running underneath. And management isn't just building these facilities on speculation.
They have actual tenants lined up.
They have contracted leases already in place. Their stated long-term goal is to exceed $1 billion in net operating income within 5 years.
Wow. $1 billion.
Yeah. And that adjusted profitability metric of $44.1 million in EBITDA, that shows the underlying operations are indeed cash positive and actually on the path toward that $1 billion target.
Okay, $1 billion in operating income sounds phenomenal. But you cannot build billion-dollar infrastructure with pocket change.
No, you absolutely cannot.
That kind of physical scale requires massive leverage, which actually brings us to a, frankly, terrifying part of their balance sheet.
The debt.
The debt. Right now, Applied Digital's total debt has ballooned to approximately $5 billion.
A huge number.
It is staggering. And last quarter, their operating margins were a negative 34.7%, and their free cash flow in the preceding period was sitting at a negative $331 million.
Yeah, that's a tough pill to swallow for a lot of people.
I mean, if I'm looking at my portfolio right now, and I see a company burning over $300 million in free cash flow while sitting on a $5 billion mountain of debt, my instinct is to hit the sell button immediately.
Right. Run for the hills.
Exactly. How is this not just a giant house of cards waiting for a slight uptick in interest rates or a construction delay to just blow it all down?
And that instinct to sell, that is exactly why there is a massive bear case against the stock right now. A $5 billion debt load is incredibly heavy.
So how do they justify it?
Well, we have to examine how that debt is mechanically structured. Because, lenders do not hand over billions of dollars to a cash-burning company unless the underlying assets are structurally ironclad.
That's a good point. Banks aren't in the business of losing money.
Exactly. Recently, Applied Digital successfully completed a $2.15 billion private offering of 6.75% senior secured notes due in 2031.
Okay, so a massive cash injection.
Huge. But that specific $2.15 billion injection is purpose-built and entirely ring-fenced to fully fund the upcoming 200-megawatt Polaris Forge 2 campus.
Wait, so by ring-fenced, you mean they absolutely cannot use those funds to, like, cover executive payroll or patch up operational losses in other departments?
Yeah, they can't touch it for that.
It exists solely to build that specific revenue-generating facility.
Exactly. It completely removes the near-term liquidity risk for their most important growth vector. I mean, they're not going to run out of money halfway through pouring the concrete for Polaris Forge 2.
That does change the picture a bit.
It does, and they've also been aggressively de-risking their credit profile. They recently restructured their leases with CoreWeave.
That's the massive cloud provider, right?
Yep. They restructured to secure unconditional guarantees on the rent payments. And by doing that, Applied Digital secured an investment-grade A3 rating for those tenant obligations.
Hold on, I'm stuck on this point. Applied Digital is the company borrowing the money and sitting on the debt. So why does the bank care about CoreWeave's credit rating? Isn't the debt still on Applied's books?
It is, but in the world of infrastructure financing, your ability to borrow money cheaply depends almost entirely on the financial strength of the person paying you rent.
Oh, because that's the income source.
Right. Because CoreWeave is now unconditionally guaranteeing those lease payments, the bank views that future revenue stream as highly secure.
So an A3 rating is good.
An A3 rating essentially means that specific stream of income is viewed as being almost as safe as a government bond.
Oh, wow.
Yeah. By securing that rating, Applied Digital can go to lenders and secure significantly cheaper refinancing options down the line. They are effectively renting CoreWeave's stellar credit rating to lower their own borrowing costs.
That's actually brilliant.
And don't forget their legacy data center hosting segment, the old business, is still churning out stable cash. It generated $13.9 million in segment operating profit last quarter.
So that legacy cash acts as a crucial financial buffer while this whole AI expansion is underway.
Exactly.
But, banks do not give you government bond interest rates unless the underlying asset is practically irreplaceable. We need to look at the physical reality of what Applied Digital is building, because that is the actual moat protecting this entire operation.
The physical infrastructure is everything here.
Right, because hyperscalers, these massive tech giants driving the industry, they're projected to spend nearly $700 billion annually on AI infrastructure.
The 700 billion.
But as we established at the beginning, you cannot just plug $1 billion of AI chips into a standard wall outlet. The real constraint on AI isn't manufacturing the chips anymore.
No, they have the chips.
It is the physical limitation of the United States electrical grid. The grid was simply not built to handle single buildings drawing 100 megawatts of power 24 hours a day.
It's unprecedented power density.
Right. And Applied Digital recognized early on that power generation and thermal cooling would be the ultimate bottlenecks. So they set up shop in places like North Dakota, securing extremely low-cost power and taking advantage of a naturally freezing climate.
Yeah, that physical bottleneck cannot be overstated. I mean, for decades, traditional data centers have used air cooling.
Just massive fans.
Right. Think of traditional air cooling like trying to cool down an overheating marathon runner by just putting a giant fan in the room.
It doesn't work.
It's highly inefficient, and it simply cannot handle the thermal output of modern AI graphics processing units. They run too hot.
So what do they do instead?
Well, what Applied Digital has built is a 100 megawatt direct-to-chip liquid-cooled data center.
Okay, so sticking with that runner analogy, direct-to-chip liquid cooling is like giving that marathon runner an IV drip of ice-cold saline straight into their bloodstream.
That's a great way to put it.
They are applying the cooling mechanism exactly where the heat is generated, right at the processor level, rather than just blowing cold air around the room.
And that targeted cooling is what allows them to run these high-density AI clusters without melting the hardware.
It's necessary.
It really is. And what makes this a formidable moat is their first-mover advantage. You know, competitors are currently sitting in local town hall meetings, arguing over zoning permits, or waiting on 3-year backlogs just to get a power transformer delivered.
While Applied Digital is already turning raw grid power into live, liquid-cooled AI capacity.
Exactly. They are already operational and cashing rent checks while everyone else is still looking at blueprints.
That's a massive head start.
And that live capacity creates massive switching costs and immense pricing power. If you are a hyperscaler with billions of dollars of AI hardware just sitting in a warehouse, you are bleeding money every single second. Those chips aren't processing data and training models.
You can't afford to wait.
No, you need reliable infrastructure today. You cannot wait 3 years for a competitor to pour concrete. Applied Digital has the infrastructure ready right now, which gives them all the leverage when negotiating those long-term unconditional leases.
With companies like CoreWeave.
Exactly.
Okay, so if they have the power, the live liquid-cooled capacity, the ironclad financing, and clients absolutely desperate to sign leases, why is the stock sitting where it is? Like, how is Wall Street actually pricing this right now?
That's the million-dollar question.
Right, because currently the stock is trading right around $24 to $25. And interestingly, right after that earnings report dropped on April 8th, the stock suffered a brief sell-the-news dip.
Yeah, people saw that $100 million gap loss and panicked.
They panicked for a minute, dumped shares, but then sentiment quickly reversed as the institutional money digested the actual quality of the adjusted revenue. But there is still a massive valuation gap right now.
Well, a huge gap.
While it trades at $25 today, analyst price targets are dramatically higher. Citizens maintained a market outperform rating with a $40 target. And Roth MKM maintained a buy rating with a $58 price target.
Yeah, $58.
That is well over 100% upside from where it currently sits.
And this raises an important question about market psychology, Why does that gap exist?
Why do you think it does?
Well, the market is currently pricing in heavy execution risk. Building ultra-dense, liquid-cooled data centers at this scale is notoriously difficult.
It's not easy.
No, and the market is collectively saying, we see the potential demand, but we need you to prove you won't trip over your own shoelaces during construction.
Fair enough.
However, that post-earnings sentiment reversal suggests a profound psychological transition is taking place right now. Institutional portfolio managers are finally stopping treating Applied Digital like a highly speculative crypto miner.
They're seeing the real business.
Right, and they are starting to assign it the premium valuation multiple of a validated high-growth AI infrastructure play. We're actually seeing a wave of cluster buying from insiders.
Oh, really?
Yeah, meaning the executives actually running the daily operations are buying the stock with their own personal money at these levels. And major institutional players like Federated Hermes have significantly increased their stakes.
We really have to talk about how this stock actually moves on a daily basis, too, because it is not for the faint of heart.
No, it is a wild
The
ride.
beta shows it has a massive beta of 7.34. And translating what that means for your portfolio, a beta of 1 means a stock moves perfectly in sync with the broader market. Like if the S&P 500 drops 1%, a beta of 1 drops 1%.
Right.
But a beta of 7.34 means this stock experiences violent high-stakes volatility. Like if the broader market just sneezes, this stock catches a severe cold. But if the market goes on a sudden run, this stock absolutely sprints.
And that extreme volatility, it's a direct byproduct of the re-rating event we just discussed. When a company transitions from a lower multiple industry to a premium multiple industry, algorithmic trading models and portfolio managers constantly adjust and readjust their pricing assumptions.
So the price swings wildly while they figure it out.
Exactly. The price action becomes incredibly violent during that discovery phase. But the fact that insiders are buying at these levels signals that those closest to the concrete pouring believe the execution risk is vastly overstated by the market.
They think the $58 target is real.
They believe that $58 price target is entirely realistic once Wall Street fully completes this psychological transition.
Okay, so we have this massive gap between the current $24 share price and the $58 analyst target. For you, the investor managing your own portfolio, what specific scheduled events or operational milestones do you need to be watching for over the next 3 to 6 months to see that gap actually close?
You need to keep a close eye on the catalyst calendar.
Right. Looking ahead, the first major fundamental hurdle is their July 2026 earnings, which will be their Q4 fiscal 2026 report.
Yeah, and the critical metric to watch there is the revenue contribution from the second 150 megawatt facility at the Polaris Forge 1 campus.
Because we saw that the first 100 megawatts brought in $71 million. Now we need to see that second, much larger phase come online and start printing money.
Exactly. Secondly, you need to watch for construction milestones regarding initial operations at the Polaris Forge 2 campus.
Right, since they have that $2.15 billion explicitly locked in a vault to build it.
Yeah, so any news indicating that construction is running ahead of schedule will be a massive positive trigger for the stock price.
Those are the scheduled operational fundamentals. But if we connect this to the speculative upside, there's a massive unconfirmed rumor currently circulating that investors need to monitor closely.
Oh, the Delta Forge rumor, yes.
There's intense market chatter that Applied Digital is in advanced discussions with a third unnamed investment-grade hyperscaler for a staggering 900 megawatts of capacity at their future Delta Forge 1 campus.
900 megawatts.
Just to put that physical scale in perspective, that is roughly the total daily power consumption of a medium-sized American city, dedicated entirely to artificial intelligence processing for one single client.
It's mind-blowing.
It's not just a big building, it's a sprawling complex of power substations, cooling towers, and fiber trenches.
And it is an astronomical amount of power to secure in today's grid-constrained environment. I mean, if they actually land that contract and secure a third investment-grade hyperscaler for Delta Forge 1, it would act as the ultimate validation catalyst.
It would prove they are the undeniable leader.
It would instantly de-risk their future revenue pipeline for the next decade, completely erasing that execution risk discount we talked about.
Yeah.
Landing a 900 megawatt whale is exactly the kind of headline event that forces algorithms to instantly reprice the stock.
So it could close that gap between $24 and that $58 target in a matter of days.
Oh, easily.
It takes them from being a participant trying to catch the AI boom to being an absolute irreplaceable cornerstone of it.
Exactly right.
So bringing this all together, the overarching thesis here scores an 8 out of 10 on the bullish scale.
I agree with that.
Yes, there is execution risk, and yes, staring at a $5 billion debt load on a balance sheet is intimidating until you understand exactly how carefully that debt has been structured, rated, and ring-fenced.
It's managed debt.
Right. Ultimately, Applied Digital represents a highly compelling multi-year hold. It offers a classic picks and shovels play for the artificial intelligence boom. Instead of trying to guess which software company is going to win the AI software race, you simply own the physical roads, the freezing water, and the electricity they all desperately need to compete.
You're betting on the infrastructure.
Exactly. I want to leave you with a final lingering question to ponder as you look at the broader market. We keep hearing about hyperscalers pouring $700 billion a year into building better, faster AI models.
Yeah, nonstop spending.
But we know that physical power generation, and the ability to thermally cool these massive server farms are currently acting as the ultimate bottlenecks to human progress. So at what point does the physical infrastructure like the raw acreage, the water rights, the heavy transmission lines in freezing places like North Dakota, at what point do those physical assets become more inherently valuable and economically scarce than the AI software itself?
That's a fascinating thought.
As we sprint toward a purely digital future, is there a hard, physical, earthly ceiling to our digital revolution?
Something to really think about.
Thanks for joining us, and we'll catch you on the next one.